A top leader panics. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, China just unleashed the unthinkable, and I want you to see exactly how this is going to send the world into the next financial crisis. But it's not just Xi Jinping that's panicking. As you're about to see, Joe Biden is next. Now let's head over to Goldman, where he picked today's story up with a headline as the PBOC is reportedly ordered to inject liquidity to the economy via government bond purchases. Now, if this is sounding a bit like quantitative easing, well, it is exactly that. And we know that central banks do not do quantitative easing unless something is seriously bad. And in China's case, what do we know? Their economy is headed into a recession. Their property developers are insolvent along with their banks. They're seeing consumer price deflation. Of course, now the biggest problem is their currency is spiraling out of control, leaving one option left, and that is a massive devaluation. But Xi Jinping doesn't want to do that. So now we're seeing the last-ditch effort. And as I'm making the case, this is what is exactly going to send the world into the next crisis in a way that nobody will believe. The offshore media reported today, that's March 28th, that President Xi Jinping ordered the PBOC to inject liquidity into the economy via buying central government bonds, or CGBs, quoting his previous comments on monetary policy at the Central Financial Work Conference last year. Quote, he said the People's Bank of China should gradually increase the trading of treasury bonds in its open market operations. Now, what's interesting about this is if you think about trading bonds, when a central bank buys them, they're actually pulling them off the market, leaving less bonds for the public. The idea here is what this should cause interest rates to do is decline. Now, this matters in a big way because what I want you to think is in a debt-based economy, how do you get people to borrow? Well, if higher rates aren't spurring demand, well, then there's only one thing is needed, and that's lower rates in a big way. And though the exact quote didn't seem to point to a direct order for the People's Bank of China to buy government bonds in the secondary market, some investors interpreted this news as a green light for rapid PBOC balance sheet expansion, and we'll show you why. Of course, this makes perfect sense in terms of supporting the yuan, why Xi Jinping needs to do everything to keep the yuan from going to zero. In our view, the PBOC would likely alleviate any upcoming supply shock via indirect purchases, similar to the experience of 2007. Now, I want you to think back to 2007. The U.S. economy was actually doing pretty well. We were sure in a big property bubble that we know would later explode. But there was a catalyst that started the downward spiral. And as you're going to see, it was China. And I'm going to show you exactly how it can happen again. And what we note, this would guide long-term government yields down in China as investors would price out the impact of supply shocks. But from the perspective of economic growth, the overall augmented fiscal deficit matters to the macro picture rather than the change in the PBOC balance sheet alone. Now let's take a look at what's going on here, because if you're China, you are the world's largest exporter of the U.S., the world's largest importer. So on this chart, we're going to look at imports into the United States, and the issue here is I want you to see the impact on higher yields, why eventually central banks are going to have to cut, and in a big way. While many people believe we're in a higher interest rate regime, the bottom line is when demand goes away in a debt-based economy, there's only one way to get it back, and that's cut rates. And you got to cut them big, as you're going to see. Because looking ahead, what do we know? That in imports of goods into the U.S., this showed in blue on a year-over-year rate of change. When there's a deceleration and even a contraction below the horizontal black line, you'll note the 10-year Treasury yields in red, well, they decline. In fact, looking forward to where we're at now, you can see along the way, every decline in imports and goods was matched by a decline in yields, except this time we had a big drop in imports, and everyone has said no, rates need to go high and stay high and be there for longer, including the Fed. But the damage this is going to do, well, we can go back to the 1980s where we can see the Fed did not actually react to a slowdown in the economy. Here you can see imports of goods scaled down. What happened? We had a recession, took another leg down, had a second recession, and you'll notice yields were driving higher until they went went into a full collapse, suggesting that perhaps Xi Jinping realizes, look, it's time to get rates down. At the same time, we've got to save the yuan because the world, well, it doesn't really like currency devaluations at all. And here you can see the import price index, this chart a little smoother again. This is pricing coming into the U.S. If you want inflation, which mind you, every central banker does want inflation to some degree. They want to inflate away the old debts. That is the game of a debt-based economy. You don't like deflation. It is indeed bad news. Now, many consumers like it, but not all governments like it at all. In fact, they hate it. Here you can see the import price index for all commodities coming into the U.S. against 10-year treasuries. And again, you see prices going into deflation here shown back in the early 90s. What happens? Yields are coming down. You see it happen again in the late 90s. Into the dot-com bubble, global financial crisis. And what do you know? That each and every time 10-year treasuries are declining. This time, you have import prices negative, which put downward pressure on U.S. consumer prices, and the market keeps saying rates need to go higher. The challenge here is this is going to obliterate demand at some point. Well, noting that the economy is already slowing down, at least here in the U.S. and the world, but at some point, all of a sudden, things go from slow to fast, and that's starting to happen in China, which is why, of course, we note that Xi Jinping is panicking. And the PBOC did purchase CGBs back in 2007, and we're going to take a look at this to facilitate currency asset purchase for the foundation of China Investment Corporation. So you want you to think about, wait a minute, how does this have anything to do with currencies? Well, let's say you've got a bank that's sitting on bonds, and they don't have any extra cash. You go in and you buy the bonds, giving, of course, the banks cash. And what do you tell the banks to do with that cash? Buy your currency. You see the math? And that buying of that currency puts a floor underneath it, wipes out the speculators, and next thing you know, everybody's happy, and this worked through an indirect approach. Now, back then, the PBOC purchased about 1.35 trillion from the Agricultural Bank of China, and now if they were to facilitate the ultra long-term bond as it did in 2007, this would largely alleviate the liquidity impact of an incoming bond issuance, all else being equal. That said, the PBOC has alternative options to accommodate the supply shock, such as cutting the reserve rate and MLF operations. We'll note that probably China's going to do everything they need to do to stem the decline of the yuan and their economy. Now, the question is, can you make money trading this? The answer is yes. More importantly, when everything comes unwound, can you protect your investments and portfolio? Yes, we give you all the tools to that, and even better, a 30-day free trial. My competitors, man, other channels, they're calling me, telling me, Steve, you got to get rid of your 30-day free trial because we only give 7. And your subscribers are making more money. You're taking our people away. But then let me tell you how we do it, because we take the machine positioning. These things drive hundreds of billions of dollars in the market. When they are at max short positions, we show you the trigger point. We give you a video. We show you how to trade this and make money. And now let's say you're a tactical trader. We have a second report that takes all those tactical indicators, the ones where you find yourself getting in late and out early and just struggling to make it work. Well, we take all of them, add them together, add a proprietary overlay, give you again the signals every day on the report, and a video on how to trade it. That is why our subscribers are so successful, and you can be too. You can protect your portfolio, you can make money trading, and you get a 30-day free trial while supplies last. Links in the description below, because what is coming again is the next financial crisis. You're going to want every tool at your disposal. Ours by far cheaper than just about anyone else's, and more valuable. As the PBOC purchased, here you see government bonds from the Agricultural Bank in China back in 2007. This chart's really obvious what exactly happened. But now let's take a look at how this affects global bond yields. Because you might be thinking, well, wait a minute, if China does something, does it really have any effect on what's here going on in the United States? The answer is absolutely yes, it does. Here we can go back to 2007. And what do we know? That rates were kind of trending slightly higher. They weren't breaking out, but we could see that happening today. And then what happened? They went on a massive downward move into what we now know as the global financial crisis. Here you see in the gray shaded area. Now, let's overlay this and look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. That will be in blue on net. Anytime that blue line is above that horizontal black line, what does it mean? Banks are tightening standards. Now keep in mind, banks already have lending standards fairly tight, but if rates were to go up, it gives them margin to lend. So if rates start to come down, well, that compresses, of course, the big problem banks have. It means they tighten lending standards even more. In a debt-based economy, that means less currency created. It just causes a constriction in credit, and next thing you know, an all-out crisis. And sure enough, that's exactly what happened in 2007. Rates started to fall, and what happened? The banks tightened lending standards in a huge way. The catalyst here being China. Now, let's take a look at what's going on, because it's not just Xi Jinping that's panicking. You see this move, and I wanted you to see that it could send the global economy into a recession, drive U.S. yields down. We're going to look more at this data. But the reason I'm suggesting President Joe Biden is going to panic next, well, he's been bragging about the labor market being so robust. But the Philly Fed says, hey, wait a minute, not so fast. And here we see from Zero Hedge, the Philly Fed admits the U.S. payrolls are overstated by at least, 800,000. And that's not going to go well, especially headed into the next election. But if this suggests that the U.S. economy, in terms of its labor market, is weaker than the administration, the political elites want us to believe, that means where anything could tip us quickly into a recession. And the first red flags emerged during the summer of 2022. That's when the Biden Labor Department, that's actually the Bureau of Labor Statistics, started well and truly rigging the labor market data. Readers may recall that it was back in July 2022 when we first warned that something had snapped in the labor market, and that's when a striking discrepancy emerged between the number of U.S. payrolls as measured by the establishment survey and the number of actual employed workers measured by the more accurate household survey. We showed then, after two series had tracked each other tick for years, which they tend to do, a wide gap opened in March of 2022, which quickly grew to 1.5 million jobs in 3 months, leaving many people, myself included, perplexed on what was really going on. And here you can see the establishment survey in green against the household survey. Household survey says, wait a minute, we don't agree. Meanwhile, job creation continues to go up. Now, if you're thinking that maybe there's some cooking of the books going on here, this is a tool that's been used by the government before. If people believe there's jobs that are out there, they will not only spend, they'll go looking for them, and sometimes it actually works. But there are other times, as now, it doesn't. And while some of this discrepancy could be explained with a record surge in multiple job holders, which increased by 1 million since March of 2022 to an all-time high of 8.6 million at the end of last year, keep in mind, as the establishment survey counts one worker having 2 or 3 or more multiple jobs, as well as 2 or 3 or more separate jobs. So again, let's say that you have 2 jobs. The government on one survey counts that as 2 jobs. The other survey says, no, wait a minute, you only have 1. We don't care if it's part-time, full-time, or what. And so even if it's just one worker trying to make ends meet under the roaring inflation we've been seeing, most of the gap remains, well, just say unexplained. And there was more. It was around the summer of 2022 that the Biden Labor Department, in its zeal to show job growth, no matter the cost or quality of jobs, also started fooling around with the composition of the labor market, with most of the monthly gains going to part-time workers, even as full-time workers stagnated or declined. This is a big deal because in February 2024, the U.S. had 132.9 million full-time jobs and 27.9 million part-time jobs, which is great until you look back 1 year and find that in February 2023, the U.S. had 133.2 million full-time jobs, more than it does a year later. And yes, the job growth since then has been all pretty much in part-time jobs, which increased by a whopping 921,000. But that's not the issue here. The issue really is the Philly Fed is calling the BLS's bluff. And it's not true. Here we see the Philly Fed survey on early benchmark revisions of state payroll employment, showing once again that the Bureau of Labor Statistics has indeed been fabricating jobs, as I pointed out last year in a show, to produce timely estimates of state payroll jobs that closely predict the annual benchmark revisions released by the BLS each March. To do so, We incorporated a more comprehensive job estimates released by the BLS as part of its quarterly Census of Employment and Wages program. They went on to say they found that the employment changes between June through September of 2023 were significantly different in 27 states compared with pre-benchmark state estimates from the BLS. Check this out. What this means is, of course, the BLS has overstated payrolls by 800,000 through December of 2023. This according to, again, the Philly Fed. And it means that stellar 230,000 average monthly increase. And what do we hear from every political elite? We hear from the Fed. We hear from, of course, the Biden administration. Look at all these jobs created. Well, if you fix and make that adjustment, well, what it means, the true average monthly payroll increase in 2023 was only 130,000, suggesting that the U.S. economy is indeed nowhere near as strong as it appears. This means the labor market, if we see rates come down, could actually crack. Now, I know you're thinking, wait a minute, that means falling rates, that should be good for the economy, except it means financial conditions are tightening. And for the labor market, well, that is indeed bad news. Here we can see, going back to that previous slide, what do we have? The market yield on 10-year Treasury yields in blue, showing that China driving yields down. What happens? The Fed funds rate in red. Of course, we know the Fed panics. They start cutting rates. We've got the yield curve in red. That means 2-year yields are falling. Financial conditions are tightening. And what is that overlaid against in purple? Continued unemployment claims, they trend higher. That means, of course, if China indeed is engaging in QE here, they are setting the first stages now for sending the world into an all financial crisis. It will have a direct impact on the U.S. economy and the labor market. And this, my friends, ahead of the next presidential election. And as far as the U.S. economy, you can see today disinflationary path stalls as non-durable goods prices spike, but supercore PCE slides. And one of the Fed's favorite inflation indicators, this is the core PCE deflator, was flat at plus 2.8% year over year, the lowest since March of 2021. However, the headline PCE deflator stalled in its deflationary path, rising to 2.5% year over year. But it's not going to stay there long, because what we can note is that if indeed China drives global rates down, this means personal consumption expenditures are going down too. Here you can see back in 2007, rates start to come down. And while we see a little lingering inflation, mainly due to oil, notably PCE comes crashing down. You see it following in each and every time. A lead in yields tells us where personal consumption expenditures are going. This time, if we see a decline in yields, you can expect, of course, inflation to come tumbling down in a big way. And that means the consumer prices, well, that's going down too, as we can note that PCE here shown in blue against the consumer price index in red have a very strong and long-term correlation and relationship. This suggesting where the PCE goes, the consumer price index falls. Here we can zoom in and see the discrepancy again. Consumer prices in red. Everyone believes this is headed up. Well, PCE says indeed it is headed down. Again, we give you all the tools to trade this. Again, check out those links in the description below, because what we see is income and spending both rose in February as consumers are optimistic about the economy. They want to believe the soft landing is here, with spending far outpacing income. The danger here is as we see a rise in unemployment claims, watch out below, because what just happened is this is coming at the expense of savings. Now overlaying the personal savings rate against yields, the yield curve, and the federal funds rate. What we saw going into the financial crisis is consumers drained their savings just in the belief the economy was going well. What happens? Yields come down, the yield curve goes higher, it steepens, the Fed cuts rates, and next thing you know, we're in the midst of financial crisis. You can see it happening again right now in the charts. That is why I'm so concerned that President Xi Jinping is panicking. He doesn't know it, but he's going to send the world into the next financial crisis. Won't be long, in my opinion, before Joe Biden is panicking as well. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.